The US election, there's no getting away from it, is the big story, certainly for us, great for the trade. It puts us into a new geopolitical regime that obviously is going to be unpredictable, but also we have a president-elect who says he wants to end wars rather than start them. So there are going to be changes for the insurance sector to deal with. Rachel, perhaps we could start with you. How should insurance leaders be thinking about this new geopolitical regime we're heading into?
It's a great question, and we pulled together an emergency group heading into the election to try and work out what does the reaction need to be. We're sort of thinking about it. Yes, if manages to end the war in Russia-Ukraine, actually then great for geopolitics, potentially not amazing for some of the aviation cases that are working their way through. So there's definitely a balance to be had. I would look at it slightly more of not what necessarily the president-elect is going to do or says he's going to do. What we're aware of through all of the democratic elections that have happened throughout the course of this year is an increased polarization in views. And so regardless of what any one leader says that they're able to achieve, polarization does not lead to more political stability. And so I think we're going to be continuing in this heightened political instability. That then obviously causes issues for us in terms of, unfortunately, wherever there's political instability, there are obviously huge opportunities from an insurance point of view, but we have to be aware that when we're taking advantage of those opportunities, we're pricing for the risk adequately. We're aware of what we're taking on. So I think it's that we need to have a clear understanding of the exposures that we're running,
yes,
the exposures to the capital and the balance sheet, that we are taking risk appropriately and well profitable.
Are you recasting your view of those aggregations or scenario plans, thinking towards the Trump White House? So, in the sense that, how does that change the dynamics in Taiwan? How does that change the dynamics?
Yeah, I think we're certainly definitely relooking at some of the realistic disaster scenarios for China, Taiwan Straits, thinking a lot more about what the Middle East, how does the Middle East play out now? So we just think some of it is in the moment scenario planning. We just don't know. It's more uncertain.
Could it be a less unstable world?
Yes, I think it probably could.
Yeah, okay. Not great for everyone, though, obviously. Robert, bring you in here. What's your kind of take on how the US election is going to sweep through kind of geopolitics?
I think the first remark is maybe, as an industry, we were and we will continue to deal with uncertainties. Otherwise, we wouldn't be sitting here. I think it's a very important point which we shouldn't forget. We can go long time back, world wars and other things. So this uncertainty element as such is nothing new. Maybe we got a bit sleepy, Stephen related to that. We're coming out of a very good time. So clearly there's more uncertainty ahead of us that will also create opportunities. But right now everyone is starting to read the tea leaves and try to figure out what is going on. There is one interesting element which at the moment gets very little discussed. And that is the debt and fiscal situation of literally every single country. Everyone. You can start in Russia, you can take the US, you can take Europe. The only exception I would quote is maybe Japan because they self-finance the whole thing. But this debt situation, the indebtedness of most countries on these planets, and you can take also the emerging countries, is going to be a problem. How do you want to finance war if you don't have money? How do you want to finance social stability if you don't have money?
Yeah.
That's the one aspect which I consider a bit the elephant in the room. The rest, time will tell us, and we have tools how to deal with it.
Yeah, I've been writing a lot about it in my new job. Do you think those fiscal strains are do you think that's going to be a big political issue for next year? As we see the kind of interest payments on countries'
I think
rising?
yes, because France is still struggling to agree on a budget. Belgium has the same. Germany has not agreed on a new budget. We know, based on what Trump has said, that will increase the debt significantly. So you can expect, depending on how the dice fall, that will go to lengthy discussions. We know a lot of countries are refinancing. China is under pressure.
So I spoke to a CEO of a big European insurer about this recently. Does it change the relative attraction of of investment grade credit versus sovereign debt? This picture, the sense that yes, you're being remunerated with much higher yields on government bonds, and yet like you said, the fiscal situation in certain countries is strained. Is it, the relative preference of that versus high quality corporate debt, is that changing? Or do you think insurers will just continue to buy a lot of government debt? It doesn't really matter.
No, I think it goes back to what Rachel said. It's this increased focus on risk management, exposure management, that will tell you where the dice will fall. People and investors will look much closer, not only to the yields, but the adjacent risk which is attached to that.
Christian, can I bring you in just on the broader geopolitical regime? We obviously don't know how it will be constituted, but it will be different. How are you thinking about it now?
So we've been thinking about this for a while because I think the U.S. back probably to 2016 is kind of withdrawn somewhat from the global leadership role, and so and you've had the kind of concurrent rise of China. So we've gone from a period of essentially a unipolar world to, a multipolar world, but Russia's now the junior partner to China, right? So there's some big differences between, I think, the world we're in now versus the bipolar world of, the Cold War era. We talk a lot about the wars, and I think what is there's certainly relevant, and the industry has, paid quite a few claims and will continue to do so coming out of some of these situations, but it's also spilling out, I think, onto the streets of countries. And you're seeing, you've seen the situation in the Mideast. We've seen what happened in Amsterdam just in the last few days. Yeah. That kind of instability and I think, kind of global disruption isn't just, isolated to war zones. And so as with my insurance hat on, I think we want to make sure that we're thinking very carefully about, the product we're selling, what we're kind of affirmatively covering, yep, how we're understanding the exposures, making sure that we're not overexposing ourselves, but also trying to be there at the end for customers who need this kind of coverage, yes, as well. And and that is a delicate balance. But I think at the end of the day, we've approached that from a couple ways. One is to try to really kind of democratize data within the organization and make sure that everybody has really good access to the dashboards and all of our data sets across the company. The other is to institute, bring in a lot of external speakers to speak on kind of some of these more macro issues that are going on. Yeah. My biggest takeaway from that is predictions are really difficult, and usually wrong. But you really have to kind of, I think, the pace of change is rapid, and so we have to stay on top of that and continue to kind of push out the most recent data quite quickly. But I think it's a very difficult situation to kind of predict what the world's going to look like in 6 months.
There's obviously been over years efforts to strip out some of that civil commotion and risk from kind of property insurance. Do you think there's still within kind of broad policies, there's still an exposure there that's not being adequately priced towards that kind of social instability? And
yeah, I mean, it's the unknown unknowns, right? It's the things that we don't think about that usually hurt us the most in this business. And so that is the thing that, keeps me up at night. If anything keeps me up at night, it's what am I not thinking about, which is a particularly difficult question to answer.
Good way to stay up very late.
But yeah, I do think that there, and this is actually an area where I think technology can help, but contracts actually are what matter at the end of the day when you actually get into a claim situation with an insured. And I think we also need to remember that is the primary contact that we actually have, and the most significant contact that we have with our customers is actually when it comes around to paying a claim most of the time. Yeah. And so we have to be there to pay the claims that we should be paying, but we also want to make sure that we're offering the product that we're intending to offer, and that they are very clear on what they're buying. And insurance contracts are inherently not clear at times. And to the extent that we can improve that, I think that helps. I think and we're probably going to touch on tech a bit later, but AI and some of the large language models actually lend themselves very well to parsing through contracts, yes, and comparing coverages across contracts across your company. And I think there's a lot of pretty easy wins that could be done there.
Just before we move away from geopolitics, Rachel, interested by one thing you said about US-Russia and how that could affect the aviation litigation. Obviously, the mega trial is ongoing in London. There's various kind of litigation going on. It's a difficult thing to comment about further, but, what is the concern there that, a very different relationship with between Russia and US changes the legal position, or, can you just simplify?
Yeah, can't say too much because obviously because they're currently working their way through the courts, obviously. But it is, one, that they're exceptionally difficult cases. We were dealing with a status quo, the situation that we thought we understood in order to try and get some form of resolution to the litigation. And then if that rug gets pulled out from underneath you and suddenly you have a different regime, or you have a Russia that has, there is no longer war with Ukraine because Ukraine has been forced to just sort of,
give up Crimea.
Give up Crimea. Well, that is suddenly we're in a different negotiating position. Some of these cases aren't necessarily coming down to law. Some of it is coming down to there's geopolitics involved with these cases. It's not just legal. So I think it's just more, it's really difficult in the middle of a legal case when you get that form of potential structural change.
Yes, understood.
Politics.
Well, let's talk about something else that's really difficult, climate change. So obviously near-term profitability, and since we met here last year, has improved. And yet, there are areas where there's still a lot of affordability stress. So while reinsurers are doing better, homeowners, businesses are struggling. Maybe, Robert, start with you on this one. So the broader question would be, is climate change making some parts of the world uninsurable? Maybe that's happening, but it's also making the insurance sector unstable in certain geographies. How do you think about this?
I think there's a short-term impact and the long-term impact. Long-term impact is much more important for the future of our entire industry. So whether we are needed or not, the short-term is more how do we respond to unknown or not modeled risk like the flood risks. Because clearly our models are geared to the big wind events, but not necessarily to the flood events. And if you just take Europe this year, I would say, some of these events were certainly not modeled properly. So there's a question on how do we deal with the immediate threats to our bottom line, which we are facing. It's partially a technical discussion, it's partially an industry discussion. What you have then as a consequence is a transition question. And if you look at Austria, that was the first time I actually heard it. Should we repopulate the areas which have been flooded? Can we afford that people are rebuilding their houses in that area? And if you go back to the flood area, the Ahrtal in Germany, that's already 4 or 5 years ago, they're still rebuilding. So that valley still looks like it got hammered 2 years ago. And indeed, it's 5 years, I think, ago then. So there's a question of clearly a lot of assets have been built in areas which are too exposed. And that goes then out of our responsibility because that triggers then the social question, the political question, the legal question. But it is important one to address the long-term aspect. Affordability of insurance for our clients. How much can we increase the prices until the average person on the street has to say, sorry, I can't pay for that anymore, I just don't have the money. So we need to strike the right balance because if we don't manage to do that, we have to admit that whenever that will happen, we have a problem with the acceptance of our industry. Yeah. And that we cannot allow to happen.
Do you want to come in on that?
Yeah, I completely agree. I mean, I think we stand a risk if we don't solve this of walking ourselves into irrelevance and oblivion. Like if we are not valuable to our clients, yes. What's the point in us being there? I think when I look at property risks, which is obviously where most of the climate change impacts are being seen, we've worked really hard to get them back up to a level of rate adequacy. They were well below rate adequacy for many, many years. Worked really hard to get there. And what I can see right now is that is all being given away or not all of it, but it's starting to be given away pretty quickly in year one. And I think that's really short-term thinking because that is based on today's view of rate adequacy, which is not factoring in floods or the the so-called secondary perils, which are actually some of them are pretty much close in size to the sort of the fourth and fifth of the 5 major perils. So we are not factoring in forward-looking view of risk, and yet we're still thinking we're rate adequate and we're okay to give prices back right now. And so there's somehow, if we want to be, so we've got, it's threading the eye of a needle. And if we want to be relevant, we have to be offering products that people can afford, but we also have to make sure that our balance sheets are strong enough that we are here to pay claims, because that is ultimately what we're here to do, is we're here to pick up in the event of some kind of catastrophe.
Christian, what are your views on this one?
I think, climate is actually something I think we're pretty good at. We've been doing it for a while. We've made some mistakes, but Stephen said it's okay to make one big mistake a year. Stephen, was that what you said? So
you had yours this year yet? Or?
I'm probably overdue. The year's not over yet, so give it time. So I think we do climate well. I think there is a role for a bigger conversation than just, what's the premium on your insurance policies. I think Robert mentioned it with where are we building is important. There's certain states and areas that, their entire economic growth has been driven by, people moving into the state and directly into probably some of the most riskiest areas. And then, with all the focus on increased climate risk, I always find it a little counterintuitive that we're being asked to provide coverage for that for a lower price. So, if the risk is growing, then I think, the cost of protecting that's going to grow. But there is a place for, good, strong building codes and public policy alongside that, which will then help offset and mitigate some of these risks. So we have seen progress in California, for example, on wildfire mitigation. There are things that you can do. Don't build in, right on the edge of the woodland, but secondarily, there are things that you can do to minimize, the risk of wildfire and flood as well, raising houses up.
I mean, the private sector has already pulled back from certain areas, right? We haven't addressed the kind of state schemes and the public-private partnerships, especially on flood. They're going to be coming under some pressure now, and I suppose that's one of the areas of instability that's going to then, in a second-order effect the insurance sector. Robert, is that going to be part of the challenge as you look ahead? How?
I think the challenge, because if you take public-private partnership, the flood schemes which are around, the quake schemes, they're all tools which are, so particularly the ones for the primary perils have been put in place because there was an obvious exposure. The flood schemes, they clearly come now more under pressure, but they are powerful transition tools. So they will hold up for a while, but they will be exposed to the price pressure like anything else. But it gives us the time to sit down also with the legislator to figure out what is the best approach. And again, it brings me back to that scenario which I described before. It is a point in time, and today we still have the time to sit around the table and figure out how we deal with it. Give it some years more, I can't tell you how long, most probably life will be a bit more difficult.
Yeah, and it feeds that social question you were talking about earlier, and what part, the kind of cross-subsidy we're willing to accept, all of us, for kind of riskier households and businesses. Okay, just moving on, it looks like we've got a turn in the reinsurance cycle, something that we're going to be talking about a lot today ahead of January. Maybe that is now not going to turn due to some recent hurricanes. Rachel, something we talked about in the prep for this panel was a period of instability in pricing and pricing turning on P&C, and how you make sure that people that have been used to this hard market manage that. Expand on that.
Yeah, so for me, some of this comes around about behaviours. We saw going into the hard market, there was a whole cadre of underwriters who'd never underwritten a hard market and only knew how to underwrite in a soft market. Then there is now going to be a group who've only ever underwritten in a hard market and haven't underwritten in a soft market. And actually the shift between the two is quicker than we would actually ideally want it to be. We'd all sit there and we go, actually, ideally, wouldn't it be wonderful if we had a very smooth insurance pricing cycle? But it's very, very up and down. And so some of it is, I think, from a leadership point of view, is ensuring that we provide our underwriters with the tools and the knowledge of how actually the negotiation may change between broker and underwriter when you're in the different points of the cycle. And I've seen some really, really poor behaviour creeping in of people being told, oh, and you just agree this risk because everybody else has agreed it, and they've sort of gone, oh, okay, well, everyone else in the market must have agreed it, so I'll say yes. And you just go, clearly nobody should have agreed that. That was just idiotic. It was increasing the limit on a property risk in Tampa 2 days ahead of Milton hitting, right? I mean, there's just no world that anybody should have agreed that, but the underwriters were being very leveraged in this market where suddenly they were going, oh, actually, well, maybe everyone has agreed it. I think from a leadership point of view, we need to be providing our people with a lot of support to be able to understand how that shift happens and what they need to do and what, and even things like we're starting to see back coming into London, subscription market brokerage, all of those sorts of things that we see as sort of more as softer market behaviour. And you'll have a load of underwriters trading at the box in London or, trading here who won't have seen this before and won't know whether or not it's something that you do or don't say yes to.
Yes. I'll just ask the audience if they have questions. I have more, but does anyone want to ask one at this stage of our panel? Don't be shy. I'm going to give you another chance in a second. I wanted to talk about technology because you mentioned that earlier, especially AI. We talk a lot about the opportunities created by AI, and you mentioned passing contracts and lots of kind of deep, long documentation. But there are also the risks of AI-driven cyber attacks. AI tools helping to create a lot of fraudulent claims, lots of liability risks coming from AI. Is that a source of instability that we're going to see in the sector? The kind of technology as a threat in the coming years?
It's certainly a threat. I mean, it's a big opportunity for the industry as well. I mean, we're probably not the poster child for doing tech well as an industry. And this is an opportunity, I think, to probably, make some ground on that. I mean, we think about it in two ways. I think there's certainly efficiency gains from some of the AI and different tech that's emerging. But there's also, I think, longer-term value gains where we're able to sort through bigger sets of data, triage submissions. You can, kick out the definitely nots and get the high potential deals in front of your underwriters so they can look at them. I think there's still a lot of adult supervision that's going to be needed, and I don't think we're going to be replacing underwriters, certainly not on the more specialty complex risks anytime soon. But I also think there's an opportunity to be pairing up our own data sets with large, other public data sets with our private data sets and getting some insights out of that. So I think it's going to be a longer journey than people think. And it's that usual saying that, you kind of overestimate the impact in the next year, but underestimate it in the next 5 or 10 years. I suspect that'll be true. And on cyber, I can't figure out if is itself, to be honest. I really can't. I generally think the bad guys are a step ahead of the cops.
AI versus AI and the cyber threats. Robert, come.
Yeah, I think the topic of technology is a relevant one because it connects back to the first area, geopolitics, and also to climate change, a lot of other aspects. Because as Christian, you mentioned, we are a very inefficient industry. 20 to 40% of the original premium disappears in doing stuff. And with pressure on margins, with increasing climate change pressure, dealing with uncertainties, we need to work on that. Because I guess, if I think about it, I can't think about a lot of industries which are running that kind of burn rate on the original premium. So there's a natural pressure, which we also don't like to talk too much about it, but Christian is absolutely right. We are not really efficient. Technology can help us, but we are a slow burner. It will take more time.
Technology has been slow to disrupt insurance. People made quite dizzy kind of predictions about how quickly it would, but it does seem to be that part of the financial sector, maybe especially in the specialty world, where things are quite bespoke.
It's the loss ratio that matters at the end of the day, right? Yep. I mean, it really is. So,
loss ratio and it's people business, whether we like it or not. Look around in the room.
Yeah, some of the new insurtechs that we've seen that are carriers that have come through and had their very big valuations in the kind of pandemic fueled kind of valuation bubble era, they have now founded on loss ratio, haven't they?
Yeah. We haven't done tech well as an industry, but tech hasn't done insurance well when they've tried to get in, right? There's a lot of dead bodies there too. So I generally think tech-enabled insurers will win over tech companies that come in and think they can just disrupt insurance because it's an unbelievably complex and dangerous industry.
It seems to be the startups that you see now are more working with insurance companies to disrupt little bits, whether that be pricing algorithms or kind of, platforms for diverting risks within a kind of insurer and all these kind of coterie of startups that you see, as opposed to trying to be carriers outright.
And I think that's a healthy development because it's the mainstreaming of good ideas. That will then in turn help to address the points which I made as well. Because at the end of the day, technology in our industry you can use two elements. One, driving efficiency. It's more the middle and the back office part. And the other part is improving the quality of decision making, which is the loss ratio part.
Yeah.
Give the audience a chance for asking another question. Yep, lady over there. Could we get a mic over to this side, please? I think it's coming. Marina, around this way, down the gap. There we go. Just on your left there.
Hi. One of the murmurings that people are hearing on the primary insurance side is underwriting without exclusions, i.e. you've done your due diligence on the risk, it's covered. Do you think in terms of growth and maybe to promote kind of confidence in the insurers, how do you feel about underwriting without exclusions on policies?
Who wants to take that one? Put their hand up. Rachel?
I mean, it doesn't fill me with a warm, fuzzy feeling, if I'm totally honest. There's two types. There's broadly speaking, two types of policies. There's ones which there's an all risk with exclusions, or there's one with the insurance policies. I mean, there's no getting away from it. Our insurance policies are phenomenally complicated to read and understand. They're not particularly customer friendly. I mean, I can barely even understand my own sort of, homeowners and auto insurance, right? So they're just not easy to understand. The idea that you've underwritten around all of theoretically you can underwrite around everything and you wouldn't need exclusions. I would suspect that nobody would be willing to pay the price that you would need to offer. I think that's the challenge. And ultimately, when I was underwriting, I was always told there is no such thing as a bad risk, it's just a bad price. But ultimately, the customer has to be willing to pay the price for the coverage that you're offering. So I would rather that, and there are some things, I'm not sure I dare, I'm going to say it anyway.
Do you dare?
Things like, I really don't want to get into this debate, so there's no follow-up. Things like cyber war, God help me for mentioning that here again, but things like that, there's reasons why those exclusions are there, because the aggregations are just too big for the insurance industry to take without pricing for it properly. So I do think that we need exclusions on policies.
Anyone else want to come in on that one? No. Any other questions for the audience? Gentleman here in the middle. Just round it. Oh, it's travelling down to you via a human chain. We'll get there.
Thanks. Maybe it'd be interesting if you guys can touch on social inflation, which we haven't talked about yet. We're seeing some of the more conservative reinsurers more recently kind of top off their reserves pretty materially. Any thoughts on kind of where the industry is on social inflation, and if you think some reinsurers are going to be willing to start playing offense too?
Christian?
I think there's divergent views on reserves. So I think there are some companies that clearly have not got their reserves to where they need to be. And there's others who I think feel that they have taken the pain and are probably can be more offensive. I remember listening to Stephen in probably 2019 when he spoke in New York talking about the amount of reserve hole that was out there. And that has been true. I think the way we think about it is you've got to get your initial loss picks right, but you also have to continue to just take a bit of rate to keep pace with what's happening out there. There is potential that with a Trump administration coming in, being potentially, appointing more conservative judges who maybe are a little more pro-business, that you could get an environment that's, I would say, on the margins better. I don't think the U.S. system is going to, be overhauled anytime soon, and that's going to suddenly get away from that. So, I think it's been with us for a long time. It's going to be with us for the future. I think we just have to continue to kind of try to keep up with it, because if you start falling behind, it's very, very difficult to catch up.
Give someone else just a quick opportunity. Go.
I would love it, and I think some of the reinsurers have started using this language, if we stopped calling it social inflation and started calling it what it is, which is legal system abuse, and that's what some of the reinsurers are starting to say. Because until the until the people on the juries, they're the ones that are they're also seeing this coming through in their own personal policies, until they understand that actually their actions are some of what's driving this, and it is legal system abuse, and we're having to react to it from the insurance industry. We're putting prices up, or to as you say, get your loss costs right. This isn't going to go away. So I just feel calling it social inflation feels like it's happening to people. Legal system abuse says it's something that we're all part of.
Robert, 5 seconds.
I fully agree. Thank you, Rachel, for saying that, because as long as we don't put the finger on it, it won't move. And social inflation sounds like nothing you can do about it. But I also agree with Christian, changing the approach of a legal system to adjudication, that's a very long haul. What is also interesting, just one last remark, is it's far more complex than it sounds also in our discussion. People talk about casualty, yeah, but underneath of casualty, there are various subclasses, and they play all very differently. And then you have also the time axis. So we're talking now 4 or 5 years after the bad years were underwritten. So that's the time it takes to develop. What about the new years with 30-40% price increase? So it's much more complex, but the key element is really this legal system abuse. And I think we need to put the finger on that one.
And I think it's a theme we'll be returning to in panels later. Thank you for the question. Please join me in thanking my panel for a great discussion.
Thank you.